Good afternoon, everyone. Thank you for joining us for today's Lunch and Learn. I'm Lauren Smith with the International Franchise Association, and we have a great 30 minutes lined up for you. Before we begin, I would like to let everyone know that we are recording today's webinar and will make it available later this evening on community.franchise.org. If you have any questions for today's speaker, please add them to the Q&A box, and they will be addressed toward the end. Today's topic is Evolving Trends in Franchise Financing, and it is brought to us by Guidant Financial. Here to provide today's discussion is Ralph Nilssen, Senior Director of Sales and Business Development. Thank you all for joining us today, and thank you to Guidant for sponsoring today's Lunch and Learn. I'll go ahead and turn things over to you.
Really appreciate it, Lauren. Thank you very much, and welcome to today's webinar. We do have a Q&A box, so feel free to submit questions as we go, and I will do my best to both manage the webinar and also take a look at the questions that are asked. Just to give you a quick overview of Guidant Financial, our vision is to increase the number of people who succeed in small business. And since our founding 20 years ago, we've been able to fund over 30,000 businesses. And that's securing over $4 billion in funding and being able to create over 85,000 jobs. And so we're quite proud of being able to assist entrepreneurs in their journey to be able to secure financing so that they can own a small business. Some of the services that we provide are SBA loans and helping people to secure those by packaging them. A common strategy called a rollover for business startup, also known as ROBS or 401k business financing. And then we have other options such as term loans and portfolio loans. What I want to do is talk a little bit about each one of these strategies, give you a little background about background about what they are, and then also give you a little bit of information about how some of these strategies, especially recently, have been changing. To start us off, let's talk about SBA loans. And just to give you a little background, these loans are anywhere from $50,000 to $5 million. Now, most banks don't like to fund an SBA loan under $1 million, and there's very few that'll fund under $250,000, even though when you go to the website, it'll say anything from $50,000 to $5 million. The equity injection or the down payment required by borrowers is a minimum of 10%. Now, that's the minimum. Banks can go anywhere from 10% all the way up to 30% down, and that's up to them. The term is almost universally about a 10-year term for a 7A. Now, if there's property involved, we can go all the way up to 25 years. And if there's property and a business, then there can be a blended term. But again, most of them on the 7A side are 10 years. The rate is a variable rate. Now, recently, with interest rates being as high as they are, we've seen that rate. Some banks start to offer fixed rates. But usually it's prime plus about 2.75%. Now, banks can charge more, especially for smaller loans, but universally we've seen it be prime plus 2.75%. Now, with interest rates where they are currently, and we are going to talk about that, we are seeing that rate be around 11.25% right now. And that's for a 10-year loan. Now, some banks will say, hey, we're going to give you a fixed rate of 8, 9, maybe 10%. And that'll be fixed for the next 10 years. But as we've heard from the Fed, interest rates are probably going to be trending down. And so it's not a bad idea to keep that variable rate because it resets quarterly, again, with most banks. That variable rate will increase and decrease as interest rates come down. We will see that variable rate decrease as well. So tough to lock it in at the high, but again, be aware that that's out there. Now, from a credit score standpoint, if you go to the website of the SBA, they'll say you can qualify with a credit score of 640 or better. In my experience, and I've been doing this for about 8 years, we've never been able to qualify somebody with a 640 credit score. Typically, we tell people it's a 690 minimum and preferably over 700 for the borrowers. Post-lending liquidity. And this is important because with consumer lending, typically you think to yourself, okay, I walk into a bank, I tell them my FICO score, they run it and they tell me what I pre-qualify for, but that's not how it works with business lending. There is a lot more to it. The dynamics are much more diverse. So post-lending liquidity is how much cash do you have once the loan has been funded. And so if I need a $500,000 SBA loan, then I need to have $50,000 in post-lending liquidity or cash on hand. And so that, very, very important. Cash is king. The beautiful part about SBA lending is there really is no early payoff penalty. You can refinance these loans 2-3 years into a conventional loan, especially if the business is profitable. Now, over the last few years, we have seen wide variations in interest rates. And I kind of want to show you a chart just to illustrate what we have seen. So besides me covering it, it looks like most of 2017, you can see interest rates went up and down. And then during COVID, we had a long period of incredibly low rates at 6%. And then as interest rates started to rise, we have topped out now at 11.25%, and that's prime plus 2.75%. Now, the Fed has indicated that interest rates are going to be coming down, and we will start to see these rates coming down. But this is a difficult environment for borrowers because interest rates are so high. So a lot of the questions we get are, with interest rates this high, how do the banks look at qualifying for an SBA loan? And we always say, listen, there are 5 C's that you need to be aware of. Well, and there you go. We're going to go back one slide there. So the 5 C's are capital. We want to see 10% down as a minimum, but if it's a startup franchise, if it is a franchise that has less than 50 locations open, then it could go up as high as 30% down. And banks have been tightening their credit requirements, and they will do that from time to time. So just be aware that they may, the borrower may want 10% down, but it will fluctuate and could go up anywhere from 10 to 30%. The credit score is vital. All right. The FICO score will have to be around 690 or better. Okay. And they're going to look at both borrowers. If it's a husband and wife, and frankly, any spouse, both spouses are going to have to be on the loan. Banks won't say, hey, one person can be in the loan, the other person cannot. Capacity. All right. What is the candidate's capacity to pay back this loan? Let's be frank. Banks want to get paid back, and they're in the business of being sure that they can get paid back. And so they're going to want to know how that loan is going to be paid back. And dare I say, the wish and the prayer of future profits from the business, they're not going to accept. They want to see that they have cash in the bank, or they have an income stream coming in that will cover the bills that the clients have. And they want to make sure that there's enough left over to pay for the business loan. Character. They're going to look at the character. Now, this is one I love because no one is perfect. Especially the older we get, nobody's perfect. And so keep in mind that if there are, the whole key to SBA lending is not perfection, it's disclosure. So for example, let's say in our 20s, we made a mistake, we went out drinking, and we've got a DWI on our record. Now, it's been more than 10 years, we've never had any issues since. Disclose. Just have the candidate disclose that to the bank. Don't let the bank find out about it, because they ultimately will. So bankruptcies, any kind of a felony, an arrest, anything like that, the banks want to know. And if you disclose it, most of the time, it's not a problem. In fact, if you've had a bankruptcy in the last 5 years, yeah, that's a problem. Past that, just give a letter of explanation, and most banks will accept that, especially when it's around circumstances. Now, if they've ever gotten in trouble with the government, keep in mind the SBA is a government agency. You get in trouble with the government, they're not going to approve you. If you owe back taxes, they're not going to approve you. Just keep that in mind. The final C is collateral. Okay. The banks want to collateralize the loan. Now, if the loan is under $350,000, the chances are the bank is not going to collateralize it. But if it's over $500,000, the bank has to collateralize it. And they are not in the business of collateralizing the business assets. They want to collateralize a home, a property, something that is physical, tangible that they can go in and repossess should that become necessary. And let's be real, the SBA wants to avoid that at all, and as much as humanly possible. So those are the 5 key things that the banks are looking at to qualify people for an SBA loan. Now, our solution at Guidant is very, very simple. We want to get your candidates funded, but we want them to, put forth as little effort as possible, and we're going to check with the bank. And so what we've got is a 10-step process that allows them to do just the minimums. We go check with the bank and make sure that the bank is on board. They do just a little bit more, great. Bank's on board. So that's what we look at, and what we want to make sure of is that we are having the bank on board at all times. The next thing I want to address is a little strategy called ROBS. Now, let me jump over here. Oh, we got too many things popping up here. A rollover for business startup was made legal with the passage of ERISA laws in 1974. So it's always interesting to me because I look back and I think 25 years ago, that was the year 2000. I always think that 25, 30 years ago was in the 1980s, and yet that's probably closer to 50 years ago. In 1974, wow, that is literally 50 years ago. So ROBS has been around for 50 years, and it allows an individual to take up to 100% of their existing retirement assets and invest them into a small business. And they do that without taking a taxable distribution or getting a loan. And so I want to explain this concept because a lot of people, once they understand it conceptually, the rules start to fall into place. And so if you think about investing in a public company, I have money in an IRA, I have money in a 401k. I want to invest that money by buying a publicly traded company such as Home Depot. So what happens technically? I take my retirement funds and I buy stock in Home Depot. And what happens is that those retirement funds are given to Home Depot to invest. And in return, they give me a placeholder, a paper placeholder called stock, or an electronic placeholder. And that stock goes into my retirement account. And that stock has value. And when we go online every day, we can see that value go up and go down because it's traded publicly. Now, we have not made any money at all on this investment until we sell said stock. And so if you think about it, those retirement funds go to Home Depot. Home Depot uses them to increase their value. We get stock. That stock hopefully increases in value. And when we sell said stock, we make money. That money goes back into our retirement account. We're all happy. Now, what happens if we lose money? Well, the money goes back into our retirement account. It's just less than what we started with when we invested in Home Depot. So taking that illustration, when I am investing or doing a ROBS, what we do first is we set up 2 different entities. We set up a C corporation, and then we set up a new 401k retirement plan. Okay, those 2 entities are the foundational pieces of what a ROBS is. Now, what we then do is we take the retirement funds from where they're currently at, and we roll them into the new retirement plan, the new 401k plan, the new profit sharing plan that we have created for that individual. Those funds now in that retirement plan are used to purchase stock in the sponsoring C corporation. And this is no different than purchasing stock in Home Depot, the publicly traded company. We're just purchasing stock in a privately traded company, your company or the client's company. In turn, that C corporation gives stock back to the 401k retirement plan that we have just created, essentially creating the same exact structure that I showed previously with that publicly traded company. And the cost to doing that is about $5,000, and that is the investment in the C corporation. So this wonderful little, I'm sure, take a snapshot, do what you want, and we're going to definitely pass this little slideshow out to everybody. But this gives you an idea of exactly how we do set up a rollover for business startup. Now, who is this good for? Well, business owners who can't qualify for a loan, perhaps they don't like debt, maybe they just don't have the liquidity for a down payment. And the beautiful thing is that an SBA loan can take anywhere from 2 to 6 months and maybe longer if there's property involved, whereas a ROBS can be done in as little as 2 to 3 weeks. Now, it can take a little bit longer than that, but by and large, 2 to 3 weeks. What are the accounts that we can utilize? Well, there are a bunch of retirement accounts that can be used to do a ROBS. The key thing to remember is most of the time, if the individual is working for the company that has their 401k, you can't get the money and roll it out of the company's 401k. And if it's an inherited IRA, we can't do anything with that. We can work with Roth 401ks for whatever reason. We can't work with Roth IRAs. I don't write the law. That's the Senate. That's the U.S. House of Representatives. Take it up with them. They're not listening to me. Now, some of the benefits of taking and doing a ROBS versus withdrawing the funds. Assume you have $300,000 in a retirement account. If you withdraw those funds, you're going to be paying a 10% early withdrawal penalty. You're going to have to pay normal income taxes on those funds. And if you live in the state like I do, Minnesota, you're going to pay state taxes as well. So again, you've got to take that into account. So if you withdraw the funds from a retirement account, you started with 300,000, but guess what? You're only able to use 60% of that. Whereas with the ROB strategy, you're able to use up to that full $300,000. So the way that we always tell people are some of the quick benefits of using a ROBS is that, hey, listen, it's a quicker path to profitability because you are not incurring a debt. You don't have a monthly payment that you have to make each and every month. You also have increased buying power because you're not using after-tax dollars. You're using pre-tax dollars. And so you're leveraging money that has never been taxed. Again, debt-free. There's no monthly payment here, and you are not beholden to any third party to tell you what or how to run the business. And then finally, it's very easy to qualify because if you have the money, you qualify. The ownership structure of a ROBS plays a little bit differently because it's all about shares. So I always tell people, who owns the corporation? Well, the shareholders own the corporation. Who owns the shareholders? Whoever purchased the shares. So if you purchased 10% of the shares, then you own 10% of the corporation. If you have a business partner, your partner purchases 90% of the shares, then your business partner owns 90% of the company. But if your retirement account purchases 90% of the shares, one of the most beautiful things about this structure is that unless somebody has a multiple personality disorder, this business structure is not going to argue with you. You are going to have no arguments from your partner, which is your retirement account. So if you think about it that way, it's a very, very beneficial structure. And then I'm going to skip over this next slide for the sake of time. But when you're exiting a ROBS, how do you get out of it? You've gotten yourself put into this wonderful, wonderful tax strategy to allow you to purchase a business. But what happens when you want out of the ROBS? Well, very, very easily, you sell the corporation, and when the dust settles, the cash is returned back to the shareholders on a percentage of ownership basis. So if you started out investing, let's say, $50,000 of your own personal cash at 10%, and your retirement account put in, say 500,000 or $1 million, well, whatever it went up to, whether it be $5 million or $10 million, that money is returned to you on a percentage of ownership basis. And in turn, the money is returned to the retirement account, which is why it is considered an investment for your retirement. Because when the money goes up, you make money and your retirement account makes money as well. And what are you investing in? Your business. So one of the other things to keep in mind is when you do a ROBS is that you have that C corporation where all businesses transacted, but you also have a 401k plan that works just like any other 401k plan. And the business owner and the employees can put away money into that 401k retirement plan. And if you look at the contribution limits, they are not small. Because the employee, the company, if they're over 50, they can do a catch-up provision. That's not a small amount of money that you can put away for retirement above and beyond what is being currently invested in the company. Now, a lot of people like to look at these two strategies that we just talked about and say, well, hey, let's combine them. Because with the SBA's standard operating procedures requiring 10% or greater equity injection or a down payment, a lot of candidates are combining strategies and saying, hey, listen, I'm going to come up with the down payment and the post-lending liquidity for my SBA loan by utilizing a ROBS. And then the balance will be that SBA loan. And that limits my cash out of pocket because let's be real, cash is king. That also allows me to have more money on the sidelines to be able to invest in working capital, to be able to have on the sidelines. And I'll tell you, having done this for many, many years, I've never known any business owner to go out of business by being overcapitalized. And so having that liquidity on the side by combining these two strategies is a wonderful, wonderful tool to be able to help people in this scenario. So one of the things that we have found at Guidant Financial is that many people are a little bit nervous to have a talk about financing. What do I qualify for? What can I do? And so what we've done on our website at www.guidantfinancial.com is that we've created a really powerful tool to allow people to kind of check out, can they pre-qualify? We also will give this to franchisors so that they can utilize it for their candidates as well. And it allows them to it allows your candidates to pre-flight what they may qualify for without ever talking to somebody and get an idea of what their options are. And the tool is very, very, very simple because all you put your name is your first name, last name, email address, and phone number and answer a few questions. And then before you know it, it spits out what you may qualify for. And whether that is a ROBS, an SBA loan, an unsecured loan, maybe it's a portfolio loan or equipment leasing. All of these things are available. And so we want to make sure that people understand what's available to them, what they need to qualify for those things. And I will say this is a very loose pre-qualification. Talking to somebody is always the very best. And honestly, it's the next step that they need to take in order to do this correctly. So at Guidant, when somebody sends us a candidate, we have a weekly email that goes out every week letting you as a franchise know where your candidates are at in the process because we want to make sure that they are ready and able to take advantage of moving forward with a franchise purchase. We know that Discovery Day is a very, very important day, and we want to make sure that we hit that. But not only do we want to be able to hit the Discovery Day, we also understand that getting financing is only the very first step in getting your franchise up and running and off the ground. In fact, we've created an entire ecosystem around supporting franchisees. And so what happens is we talk to them about thinking about things like payroll, accounting and tax, human resources, all the different functions that an entrepreneur needs to think about and probably doesn't want to deal with. We want to support them and help them with, and that is something that we have been able to do to help support all those business owners. Now, again, just to give you a little bit, my name is Ralph Nilssen. I'm the Senior Director of Sales and Business Development. That is my contact information right there. We've got about 5, maybe 6 minutes left. I want to be able to turn the time over to you. If you have any specific questions, I'm more than happy to address them directly. If you want to pop them into the chat, we will do that as well. More than anything, just appreciate the opportunity to share with you some of these things that are coming down the pipe and that we've been able to deal with. Lauren, I'm going to be able to look to you for a little bit of guidance here because you know how to work these controls better than I do. I can talk financing all day long, but when it comes to technology, I may be a little deficient. So I don't want to miss any questions or if there are any. So I'll turn it over to you. Oh,
Perfect. I just saw a couple come into the chat box, so I will hand that back to
beautiful.
you.
So Holland asked, how does the $4,995 fee for Rob's compare to an SBA fee? We charge a $2,500 fee to put together all of the paperwork for an SBA loan. Banks are going to charge usually 2-3% of the total loan amount and fees and costs associated with it. Okay. Drew asked multi-unit development fees for the funding of the first franchise. So great question, Drew. When you are looking to purchase multiple franchise units, and if you are looking to do a robbed, you can fund multiple franchise units and pay the franchise fee for multiple franchise units from the proceeds of a robbed. However, on an SBA loan, they will only look on a per location basis. So let's say I pay $50,000 in a franchise fee and I get the opportunity to buy 3 locations for a total of $100,000. If I can only open 1 location at a time, then I can only count the first 50,000 of that $100,000 towards my initial SBA loan. However, if that is a territory and I purchase 3 territories and I can have 1 office and open 3 territories all at once, then I can count the full $100,000 towards the SBA loan down payment. So wonderful how complicated things can get and the detail that you need to be able to know. So again, I would just please talk to a financing professional that can answer those in depth. John asks, how can an existing franchisee business fund a real estate acquisition and then build out for expansion? It's a great question, John. I want to take a second there to collect my thoughts on how best to answer that, because if it is just purchasing real estate, probably a SBA 7A loan is not the right way to go. But if it's real estate with a business on it, and then they want to build out for expansion, you want to structure that both from an entity standpoint and from your financing standpoint to allow you to open as quickly as possible, because most franchise agreements have a time limit in which you've got to open up, location number 2, location number 3. So with that, one of the things that we do is we spend a lot of time asking up front, what's your end goal? Are you wanting to purchase multiple units? Is this a 1-unit transaction? Because oftentimes, if you do a loan on the first one, and if we have enough money in a ROBS for the second one, then the third one can be self-funded by the profits from the first 2. What is tough is if you pay cash for the first one, you've locked yourself up because you have no other options. And the bank's going to want to make sure that that first one is profitable and making money before they'll finance number 2. So order of operation is very critical in looking at when do I, which financing strategy I utilize. I'm going to take a quick drink here. So hopefully that answered the questions. I will say this. One of the trends that we are seeing in franchising is a move towards multi-unit operators. And there is great benefit both to the franchisor and to the franchisee in purchasing multiple units. The key, though, is making sure that we go into this with the end in mind, and knowing that we are going to be purchasing multiple units, making sure that the financing strategy we utilize initially doesn't lock us in and inhibit our ability to grow and expand into those future locations. So what I would tell people is the best thing that you can do is find a finance company that you trust, that has experience, and involve them early in the process. Okay, now whether it's Guidant Financial or someone else, that's up to you, but involve them early in the process and make them a collaborator in the journey of your franchisees so that you're working together for their benefit. And honestly, everyone wins. So with that, I really appreciate the time. My time is up, and thank you very much, Lauren. Thank you so much for this opportunity.
Thank you. Thank you so much, Ralph. This was excellent content and excellent feedback from all of you. We really do appreciate it. Again, this webinar was recorded, and along with the presentation deck will appear on our website early this evening. You'll be able to find that at community.franchise.org. Thank you very much again to Ralph and the Guidant Financial team. And again, thank you to everyone for tuning in. Have a great rest of your day. Stay safe and healthy. Bye.